สัมมนาอันนี้อีกครั้งหนึ่งนะครับผมก็ต้องขอบคุณพีอีกครั้งหนึ่งนะฮะว่าเพราะหมอนิสาก็เป็นคนที่แบบช่วยเหลือทางสมาคมมาตลอดนะฮะที่มีสปีกเกอร์ดีๆมาอย่างต่อเนื่องนะครับเดี๋ยวผมเล่าให้ฟังไอ้ preamble นิดหนึ่งนะครับว่าไอ้ตัว topic วันนี้เนี่ยนะฮะผมเองก็ยังไม่ค่อยเข้าใจเท่าไหร่ว่าไอ้ strategic beta มันคืออะไรนะครับแต่ไอ้ตัวนี้มันเป็นเทรนด์ใหญ่นะครับไอ้เรื่อง exchange traded funds หรือที่เรียกว่า ETF เนี่ยนะฮะเมื่อวันก่อนผมไปเข้าอบรมไอ้ single license นะครับแล้วก็มีอาจารย์คนหนึ่งที่หอการค้าเนี่ยนะฮะคือเขาทำ research ออกมานะแล้วบอกว่าไอ้ตลาดไทยเนี่ยมันก็มีประสิทธิภาพในระดับหนึ่งนะครับสำหรับคนที่เรียนไอ้ตัว efficient market hypothesis มาเนี่ยนะครับคือมันไม่ใช่ weak form efficiency เนี่ยมันไม่ใช่ไงแต่มันก็มีในระดับหนึ่งที่มันมีประสิทธิภาพนะครับแต่เป็นที่น่าสนใจนะครับว่าในต่างประเทศเนี่ยนะว่าตลาดมัน efficient มากจนกระทั่งว่าไอ้ผู้จัดการกองทุนทั้งหลายเนี่ยนะฮะคือ80%เนี่ยไม่สามารถจะเอาชนะไอ้ตัวดัชนีได้นะครับคือเหมือนกับว่าเวลามีข่าวอะไรออกมาเนี่ยนะฮะทุกคนมันจะ react ทันทีจะซื้อจะขายหรือจะถือเนี่ยนะครับแต่เขาบอกมันเป็นทฤษฎีกันที่ค่อนข้างน่าสนใจว่าประเทศไทยเนี่ยนะฮะคนซื้อขายเนี่ยเป็นรายย่อยค่อนข้างเยอะนะครับและอันนี้เขาอาจจะเป็นเหตุผลตัวหนึ่งนะครับเวลารายย่อยค่อนข้างเยอะเนี่ยนะอาจจะไม่ได้ react เท่าที่ควรนะครับแล้วก็กลายเป็นว่า50%หรือครึ่งหนึ่งเนี่ยนะครับของพวกผู้จัดการกองทุนทั้งหลายเนี่ยนะครับก็ยังสามารถที่เอาชนะไอ้ตัวดัชนีได้อยู่นะครับมันก็เป็นทฤษฎีที่ค่อนข้างน่าสนใจนะครับคือมันเหมือนกับว่าเวลามันข่าวออกไปเนี่ยนะฮะว่าทุกคนได้รับข่าวพร้อมๆกันนะแต่ลูกค้ารีเทลอาจจะไม่ได้ตัดสินใจนะฮะเท่ากับพวกลูกค้าที่เป็นตัวพวกฟันทีเดียวนะครับงั้นวันนี้ก็คิดว่าน่าจะเป็นท็อปิกที่ดีนะครับที่จะมาฟังในวันนี้นะครับ so I just like to take this opportunity to welcome our speaker today. I keep on getting your name wrong actually. Keep on thinking about Jackie Chan, but it's but it's actually Jackie Choi from the Hong Kong office of Morningstar. On behalf of Thai Financial Planners Association, just like to welcome you to our little get together, and especially that you have to brave the travel warnings to be here with us today. So I'm especially grateful. Okay, so the topic today will be on strategic beta and using ETFs in combination with active managers. So Mr. Choi would like to spend about an hour and a half, presenting, and then we open the floor up for Q&A. Okay, thank you.
Hi, hello. So thanks everyone, and thanks for the introduction. And don't worry about, I'm not too worried about the talk warning, as I see it very peaceful in Thailand here, in Bangkok here. So I'll come here more often, hopefully. So thanks for the introduction again. And I'm Jackie Choi, ETF strategist with Morningstar, and I'm based in Hong Kong. Sorry, I cannot speak Thai, so I'll be speaking in English. And today I'll be talking about strategic beta and using ETF in combination with active managers. So I think just want to get a little bit sort of a statistic here. Who have been using ETFs before? Just one? Two? Three? Or advising clients to use ETFs? Are you planning to advise people or your clients to invest ETFs? Okay, I hope I would see more hands after this seminar. So I'll give you some context around this particular hot topic on strategic beta, and also showing you how to use ETFs with active managers, which we call it mutual funds in the US. So getting into sort of a bit of introduction about Morningstar ourselves. So Morningstar is an independent research provider. We offer tools, data, and research to different investment communities around the world. So this map, we have the dots on the global map. These are the different offices that we have. And yes, we have an office in Thailand too, and we have our colleagues, Pete here, our CEO in Thailand, also our other colleagues here too. So if you have any questions about Morningstar, please feel free to contact them. So, and myself, I'm the ETF strategist, and I oversee research activity for Morningstar in the Asia Pacific region. So Hong Kong, Singapore, Taiwan is for now my main markets that I look at. And Thailand obviously is included in Asia. And hopefully when the ETF market gets bigger and more active, I'll be looking more into this particular country too. So, and a bit of running down today's agenda here. This seminar today will be split into 3 main parts. I will dedicate the first part to the topic on strategic beta, from what it is and to defining it, and to looking deeper into the taxonomies. And then in the second part, I will talk about the latest trends in the ETF industry. And in the final part, I will share with you on how to use ETFs along with active funds. So hopefully that would sort of form a more sort of complete picture on how to use ETFs on different levels. So, strategic beta. Another time to show your hands. Have anyone heard about strategic beta? Just 1 or 2. Maybe you have attended the seminar yesterday too. And what about smart beta? Have anyone heard about smart beta? A little bit more hands. Well, it's actually similar. But the reason why we're talking about this particular topic is that for many years, many around the world, many around the industry have debated the specifics on how to call this smart beta, strategic beta, and how to define it. And as an independent party in this arena, we at Morningstar is uniquely positioned to actually put an end to this debate and to move the conversation beyond the simple semantics. Well, basically, what's the meaning of it? And focus investors' attention to the key questions that they're facing today. For example, are these products or strategies have lasting investment merits? How do I separate the good, the bad, and the ugly? And how do these strategies fit within the context of my existing portfolio? So step 1 down this path is focusing on putting an end to the debate around semantics. So as such, I'll be dedicating a substantial portion of the presentation on defining strategic beta and the taxonomy that we are going to develop to help investors make sense of what it is, a very broad and diverse and increasingly complex group of investments. So a lot of words here. Sorry that it's a little bit pale, but you can listen to me, which is similar to what it says here. So actually in many countries in the US, well, many places in the US and Europe, we've been having a lot of different seminars talking about strategic beta, smart beta. In fact, many of the investors are more familiar with the term smart beta. And the term itself has gained a lot of industry traction, especially in the US and Europe. And we have actually been using this term ourselves as well. But when we approached this exercise of defining and classifying this universe, one of the first steps we took was to kick smart, this term, out of the picture. The word smart is, I think, a little bit confusing because it would imply these strategies to be intellectually more superior relative to the normal benchmarks, for example, the S&P 500. Is that right? Well, we don't think so. Not every smart beta product or index is actually smart, so be careful. This is why we have opted to use the term strategic, and that's why we call these type of product strategic beta instead of smart beta. So I hope you will be using strategic beta from now on. And this term, I think, is more fitting because as many of these benchmarks actually, and then products that it tracks, these indices in these categories are designed to mimic the same sort of strategies that has been used by a lot of active managers for decades already. So let's start to define strategic beta. It is actually a growing category of indices that ETFs and other funds and investment products are tracking them. The majority of these indexes seek to enhance returns or minimize risk relative to a traditional market cap weighted benchmarks. Some others seek to address some drawbacks of the traditional commodity future indices. You may have heard of contango. These strategic beta products try to mitigate these problems, and fixed income indices too, because you would probably heard about fixed income indices are heavily invested into the indebted companies, and these strategic beta products tries to mitigate that problem as well. And in the middle of, when we speak about like strategic beta, it's actually sitting in the middle of active and passive, like the son of mother passive and father active. So similar to active managers, these benchmarks and the relevant products exploit many of the same source of returns, such as size, value, and quality aspects, or mitigate risk, or such as a volatility tilt. And similar to passive portfolios, they are rule-based, transparent, and relatively low cost, but with a strategic element in there. And I talked about cost just now, so just for your reference, looking at the end of last year, strategic beta ETFs have an average expense ratio of about 53 basis points, comparing to about 120 basis points for actively managed open-ended mutual funds in the US. So you can see the difference in terms of cost here. It's much cheaper to own these type of products than normal active funds. So I talked about the definition, and also, so now it is also important to sort of introduce you to see how we are different from the others that are using this particular term, smart beta or strategic beta. In fact, a lot of them in the industries are including indices that are not market cap weighted into strategic beta. Well, similar to us, we do that too, but in fact, some of the benchmarks, strategic beta products that we categorize are also market cap weighted. For example, those have a style tilt. For example, a dividend weighted benchmark, which first of all, they screen out the different constituents within the index by looking at the high dividend yields, and then subsequently weighting them by market cap weightings. So this is time where these type of strategic beta products have the active portion in there, as well as having the market cap weighted mechanism in there too. And in the labeling process, we do not include any pure sector indices or country indices, and anything in our trading category, such as leverage or inverse products. So at this point, I would probably apologize for putting 1,000 words before this particular picture, and which this picture hopefully should go a long way towards helping you to understand our concept of strategic beta. So again, strategic beta is a hybrid between the active on the right and the passive on the left. And allow me to use, again, the analogy of strategic beta being the son of a passive mother and an active father. So like its traditional passive mother, these products track rule-based, such as non-passive products. It's rule-based, and they are transparent and cheaper to own than the average active managed funds. And they also possess the active father characteristics, in that they have embedded an active bet against a broad market portfolio into the construction of their benchmark index. So basically, you remember that normal actively managed funds have fund managers to pick the actual stocks within a universe, but these strategic beta products have the rule-based indices that have the rules written down in the rule books, and they will execute exactly like what is written in the rule books. So you have the active and the passive portion in there. And as I said, it is also important to note that we include certain benchmarks that weight their constituents by market capitalization in this category. So many of the rule-based passive products are actually market cap weighted, and we do include some of those in the strategic beta portion. And as I mentioned, these indices will start with a broad-based benchmark and screen the constituents for certain characteristics, such as value, growth, or dividend-related attributes, and subsequently market cap the weights and for the results. And again, the common elements of the strategic beta, they're index-based, transparent, cheaper to own than active managers, and a little bit more expensive than normal ETFs that are tracking the bulk indices, for example, the S&P 500. So now I've walked through the definition of strategic beta. Now I would like to spend some time highlighting the trends in this particular strategic beta space. And this is basically why we are spending so much effort in putting these into our work these days, and also putting these strategic beta attributes and definitions into our different products as well, so that we can do the other research based on these products. So as of the end of last year, there are 355 ETFs tracking these kind of strategies, strategic beta, and the asset under management is close to 300 billion already. Well, what's that number represent? It actually represents 17% of the overall US ETF sector, so which is a pretty big portion already. And looking at the net cash flow, almost a third, 31%, last year actually went into these strategic beta products. And looking at the actual AUM of these strategic beta products, they grew 54% over 2012. And looking one level deeper, 30% actually come from new cash flow, and only 24% comes from asset appreciation. So it's actually the more product that came into the line and more money getting into these products that actually result in the strong growth that we are seeing in the strategic beta segment. So another picture that you can see the growth in this category asset, dating back to the inception of the first strategic beta ETF. And a strategic beta is actually not that new a concept. It actually started back in like May 2000, when iShares started their first batch of strategic beta ETFs, with some growth and value ETFs launched back then. So these I would call these as the first generation of strategic beta products. And fast forwarding to 2005 here, you can see the first fundamentally weighted ETF launched, and also the first non-traditional commodity ETF launch shortly after that in 2006 too, both by PowerShares. And fast forwarding further to 2011, you can see PowerShares launch another volatility weighted ETF. So, and you can also see the very fast growing 54% growth in that particular year too. And you can see it's just a very substantial exponential growth you can see here. And looking at a different angle for this growth in the strategic beta, it's actually not just an asset appreciation story, as I mentioned. The growth has been driven by increasingly strong and steady cash inflows. And you remember that I just said there was like a third of the new cash flows went into this asset. These are the actual cash flow that went into these products. But looking at the number of launches, there are also a lot that has been launched in the past few years. Looking at like 2009, there was only six strategic beta ETPs launched in the US. 16 in 2010, but the growth has been tremendous in the past 3 years, 2011, 2012, and 13, averaging 46 each year. So you can see the growth there. And that's also have driven the strong inflow too. So this is a more complicated chart here, which I think I would put a little bit of explanation here first. So Morningstar has a Morningstar rating system, rating funds and ETFs from 1 to 5, based on the how well they have performed on an after fees risk-adjusted basis in comparison with similar funds. Top 5%, top 10% receive 5-star, bottom 10% receive 1-star. So 5 stars perform much better than the 1-star, and 35% in the middle receive 3 stars. And so this picture actually shows you what? It shows you that the money actually goes into the better performing funds, better performing ETF, especially for the strategic beta products. You can see in terms of asset, in terms of number of accounts, strategic beta has performed much better, classified into the 4 and 5 much more than the traditional ETFs. And that's why a lot of money has been going into this particular segment. So I've talked about like 20 minutes already about strategic beta. Why are we doing this? Well, it is actually our overarching goal to help investors to reach their financial goals in understanding these complex products. So as analysts at Morningstar, all of us are trying to be the referee in this arena, and by laying the ground rules. That's the definitions here. And then by doing so, we can then classify them, and then highlighting the winners and call out the losers. So we can then perform research to see which are the good ones and which are the bad ones, so the investors can make their investment decisions upon them. This is all being done to help investors to navigate this increasingly complex landscape. So up until now, I've been speaking about strategic beta in a very broad terms. As I mentioned at the outset, this is a very diverse category, and we are working to develop a classification scheme that allows investors to drill down into the broader universe at a more granular level. And here we have an outline of our 3-tier taxonomy mapping the system, mapping this particular strategic beta space. So we have risk-return, risk-oriented, return-oriented, risk-oriented, and others. So basically, when we have an ETF on hand, we'll first ask ourselves whether this ETF would fall into the strategic beta sort of criteria, after which we'll put them into different buckets. So going into the 3 primary strategy attributes, return-oriented strategies look to improve returns relative to the standard benchmark. Value and growth benchmarks are primary examples. Risk-return oriented looks to either reduce or increase the risk level so that investors can pick their own risk level to invest into. Low volatility or high beta are the most common examples. And the other classification encompasses a wide variety of strategies. And these range from non-traditional commodity benchmarks to multi-asset indices. And I'll then spend a little bit of time going into each of the different categories. Risk-oriented, for example, we have dividend screened, the attribute as the secondary attribute. Dividend screened strategies seek to deliver equity income by employing a number of dividend-oriented screening or weighting criteria. And these include screening at universal stocks or for dividend-paying firms, weighting stocks on the basis of dividend payments, screening on the basis of dividend growth, or isolating firms or metrics that whether they are paying or increasing dividends. So there could be very different rules based on for these category. And second, a value. Value strategy will screen a segment of the stock market looking to identify those stocks that display value characteristics. These characteristics will differ across different index providers. Common value characteristics are low PE levels, low price to book levels, low price to sales ratios, etc. And it's just important to note that some of these strategies weight the results of their screening criteria by market capitalization too. And we'll talk a bit about growth too. The growth attribute will screen a segment of the stock market looking to identify those stocks that display the growth characteristic. These characteristics will differ across index providers. Common growth characteristics include above average long-term projected earning growth, historical earnings growth or sales growth, etc. And also some of these strategies are also market cap weighted. And looking at fundamental, it is the case that refer exclusively to the RAFI, RAFI fundamental index equity strategy, which is an institution that weight and compute these indices, which will select and weigh their constituents based on fundamental measures such as sales, adjusted sales, and cash flow, dividends, etc. So you can see that there are a lot of non-traditional reasons or criteria when selecting the actual constituents into the index, and this is what we call the strategic part of the of these kind of products. And secondly, we look at like risk-oriented. So low minimum volatility variance strategies select and weigh their constituents on the basis of historical volatility. High-low beta, we look at they select and weigh their constituents based on their beta relative to the standard market cap weighted benchmarks. And finally, the other category, the others attribute. So there are non-traditional commodity. So I mentioned a bit about like Contango and for the commodity normal commodity index. So here for strategic beta indices on non-traditional commodity, they try to use some methodology to mitigate that particular process. And equal weighted, they simply apply an equal weight to their constituent securities. For example, if they have 20 stocks in their constituents, every stock will have a 5% weighting instead of normally market cap weighted sort of method. So that's pretty much it for the strategic beta sort of introduction. Are there any questions that you may have before I go into the next section?
I'm afraid you lost me. So has Morningstar diversifying to index construction now?
No, we are actually providing these particular sort of definition and attributes so that when we see there are different index or products that are linked into these indices, then we can use these different attributes and put these products into our database to make apple to apple comparison to each other. So say for example, if there are two indices that are index A and index B, you can quickly in our database we can see that what they belong to and whether we can compare them apple to apple. Because
let's suppose they have money in just plain vanilla S&P 500 index ETF. Do you have historical performance data to compare this with, say, the strategic beta?
There will be, yeah. That will be under our different product platforms. So, for example, index or an ETF that tracks an S&P 500, we will have return data and also NAV or other portfolio data for this particular ETF. If there's an ETF tracking a strategic beta, which is say a dividend, high dividend S&P 500 ETF. We will also have the actual data on the actual return performance on this particular ETF, and we can make comparison to each other. And if there's a third ETF that is tracking another dividend-based strategic beta index, we could compare the second and the third ETF together to see, okay, by quickly using these sorting systems, we can compare them quickly and see if they have under the same category, have they performed better or worse? So we are playing the referee here. We're not saying that we are going into the computing the index, but we are trying to stop the argument of what to call it, how to classify it. These are the definitions. Right. So no more questions for now. So I'll go into the second section here today, which is to introduce you with some recent trends in the global ETF industry. So this is the picture of the different AUMs, asset under management of ETFs in different major regions. Asia Pacific, Europe, and US. You can see US has definitely been the largest of all, which is the blue bars. And over the past 5 years, ETF asset under management has tripled over the past 5 years. It's a very tremendous growth here. And the blue line AUM in the US ETF has increased a compound annual rate of 27% over the past decade. So you can see the very strong growth in these particular asset class ETFs here. I think one of the reasons is because of the low cost that it has, because cost has been one of the strongest predictor of performance of a fund or ETF, and low cost actually helps investors' performance. And so first of all, let's look at the US story here. The growth has actually not been, isn't just driven by asset appreciation. In fact, a big portion of the growth actually came in from inflows. And here you can see that the rightmost bar here is a net flow into the US listed ETFs, which 2013 made another new high in the past 10, 15 years. And another look into the US fund industry that we found interesting is that the trend of assets flowing into the passive products, of which ETFs belong to passive. Passive meaning that rule-based instead of fund managers making the investment decisions. In the past 20 years, the importance of passive products have been increasing, accounting from only 3% 20 years ago to some 27% nowadays. So you can see the low-cost reason has driven the very strong growth in the past flowing to the passive products from actively managed products. And looking at Asia, where Thailand belongs to, looking at Asia, although the red bar is still very small comparing to the US ones, actually if you sort of magnify that, the exponential growth is similar to what you see in the US, also exponential. So a little bit of context here. Size of the Asia Pacific ETF market is 1/10 of the US, and Europe and Europe is 1/4 of the US. So you can see sort of like the some comparison here. And this picture sort of shows you how assets and sort of number of ETFs are listed in the different countries of the Asia region. So looking at the biggest one, you can see Japan. Japan is one of the first movers, including Hong Kong, first movers into the ETF market. So Japan has been very active in launching ETFs, and one of the countries where I think government is very willing to use ETFs too. And I recall that the asset purchase plan by the Japanese government in recent years also include ETF purchases, and you can see how supportive the government is on the ETF industry. And so you can see AUM is the biggest for Japan within the Asia region. Second is Hong Kong, 33 billion. We have also got a very big number of ETFs, 134 now. And looking at the third in terms of AUM, China is coming in very quickly. It wasn't on the third 2 years ago, and it has come into third now, beating Korea. It's now at 22 billion AUM and only 82 ETFs nowadays. This growth would definitely be stronger as the China market further opens, as well as allowing more different product offerings in the country. Following that is Korea. Korea is 17 billion, but there are a lot of ETF offerings, 149, at which Korea is actually very active in launching very different types of ETF products, from the traditional ones that they track the Kodax or the Kospi, or even going offshore, tracking the S&P 500, etc. They have also got a very big portion of sort of more exotic type of ETFs, which are inverse and leverage ETFs, which they offer leverage, meaning that they offer 2 times of the traditional index return. Inverse being like if the index go up by 1%, the ETF goes down by 1%. So this type of inverse ETFs. These are, well, we haven't seen that in Hong Kong or Thailand yet, but they are very attractive in Korea. I think some of the reason was because Korea people are very trading oriented. They like to use these these ETFs as trading products. Not that I encourage people to use ETF as trading products, but that's how they have been using it. So looking at the other countries, Thailand, I would say Thailand is still on the infant stage in terms of ETF industry. Only 400 million of AUM so far, 18 ETFs in the market, of which 12 are equity ETFs, 2 of which are investing offshore, 5 gold ETFs, and 1 fixed income ETF. I would say, well, if the regulations and other and government would be willing to promote it a little bit more, and maybe like the stock exchange would like to promote them a little bit more, I think the growth can be a lot bigger, because ETFs, being a low-cost vehicle, has its own reason for existence in many countries, especially offering the market growth, market return to investors without people needing to invest in a lot of stocks, but just one ETF can do the work. So this can help diversification, as well as for other ETFs tracking offshore market. You can bring capital out of the country too. So this is the current picture of the ETF market. Here is what's next. So recently, a month ago, Singapore, Australia, Korea, New Zealand, Philippines, and Thailand released a consultation paper on the proposed rules and arrangements governing the operation of the proposed Asia region funds passport. I think this is a suggestion of the different countries willing and wanting to get their funds and ETFs into and out of their own country. And this would obviously create more flows into different products, and also sort of helping the asset management community too. And so what I would expect is, would there be more ETFs available in the Thailand market? I think so, because probably a lot of foreign fund managers would be wanting to come to the Thailand market to allow Thailand investors to invest offshore, well, subject to rules and regulations, of course. And also, probably Thai managers would want to go to other markets to launch some Thai market, some ETFs into other markets, which tracks the Thai industry to get external money into Thailand too. So this hopefully is how the ETF market has been building across Europe, getting money in and out of different countries. And I think with the ARFP, that this would be a chance to broadening the ETF platform in Asia. Currently, I think one of the problem, well, I wouldn't say a problem, but I would say an obstacle about the Asia market is that every Asia market is a single country, having their own regulations and having their own exchange. There are a lot of rules, a lot of different regulations. Whereas in the U.S. you have a single rule covering the whole country. In Europe you have UCITS having a very broad and general united rule in covering the whole Europe. That would help the country, the actual platform to grow. So with more united, like for example, this kind of Asia region fund passport, or even in Hong Kong, China, there is the Hong Kong China funds passporting. So hopefully that would build a stronger ETF platform to allow different ETFs to be sold in different countries, and activating more flows into different countries and out of different countries too. So that's about it for the industry trends. Do you have any particular views or comments that you would like to give here, or questions that we would like to ask on the trends?
Just a couple actually. You say ETFs in Asia. Are these actually ETFs that are managed and provided by the local fund houses? Let's say in Japan, they've got what, $79 billion worth, and these provided by the Nikkei and the Nomura's AMs of this world, or are they the BlackRocks that have the ETFs that are listed in Japan?
If you're talking about Japan, the Japanese market in particular, local ETF providers are still the dominant players. The ones that you talk about, Nomura or Nikkei, are the bigger ones, bigger players. But iShares and Spider, which is State Street's ETF arm, has already entered into the market too. But if you look at the other market, which is Hong Kong has. If you look at the bigger ETFs, which is the Tracker Fund of Hong Kong 2800, and the other bigger ETF 2823, the iShares China A-share ETF, these are by obviously Spider and iShares. These are all foreign, I would say foreign ETF providers. I think they are, well, I think one reason is that they are lucky enough to be one of the first to enter the market, and also it was the ones that have the experience in launching products in US and first being invited to launch ETFs in the region, well, in Hong Kong. And I was looking into like Thailand. Thailand, so far all of them are local players. I think in terms of like development, I think there are a few aspects. One, regulators has to do their job in allowing other players to come into the market, so that knowledge can be shared from the US and Europe. Just like Hong Kong, they invited other ETF providers to go into the Hong Kong to launch ETFs, so that local players can understand how ETF work and how ETF can be operated. And I think that would, if Thailand can do that too, that would help the industry too, so that there would be more competition and getting more product offering as well. And usually you can see the local ETFs are usually locally managed. Well, even in different countries, you have like US, usually iShares and Vanguard are the bigger players, and you see they are the ones that have locally listed and local exposure ETF that are very big. And
I'm not quite so sure whether the stock exchange has any objections. So let's say if iShares want to list the S&P 500 ETF on the SET, I would thought that there's no restrictions. Yeah.
No restriction. We are open for cross-listed ETF so far. But
But it has to
as he mentioned, all of the ETFs here are locally
I think the size sort of issue is one of the reason why foreign ETF providers has not been entering Thailand, because for the case of like iShares or State Street in Hong Kong, you can having a foreign provider providing an ETF in Hong Kong, they can get use their foreign investors to put money into Hong Kong. But if say for example an ETF provider looking at Thailand, if the size is small, they may not want to even put their first money into here to start the business. So it's like a chicken and egg problem, whether there is some sort of first move into the market first to grow the market, and then get the engine started and grow the market subsequently. So maybe, well, the government or stock exchange can probably talk to the different ETF providers more, maybe.
I think my biggest fear is that growth may bypass the SET completely. You know, as in, let's say that I'm a Thai-based investor here, and I want to invest in S&P 500 ETF. So go down to the local brokers here that can execute offshore. You know, these are the ones that are already listed on NYSE. Patra can do it, IRA can do it. So I don't really need these products to be listed, you know, on the SET, which is a pity.
That's one.
So the growth may not actually happen in Asia. Actually.
I think I will put your sort of concern into two folds. One is whether we need like overseas, well, locally listed ETFs having an overseas exposure. This is a key question because, as you said, it could be very easy to buy foreign listed ETFs, but there are risks in there too. For example, tax issues. That's one thing you have to understand before investing into that. But if you have a locally listed foreign exposure ETF, you may be very happy with the your Thai tax system before executing. So, and a lot of retail investors probably would be more familiar, more sort of familiar with the trading of the SET rather than trading and using offshore platforms. So that's one way to put your concern. But I would say yes, if the cost or sort of risk and reward makes sense, probably investors would go to the other countries to buy ETFs too. So I think if there's sort of overseas providers coming in, they have to put the cost in sort of like into consideration too, in how to like break the market as well. And the other part of your concern, I think, is whether we should have like locally listed, local exposure ETFs. I think I also have this conversation with my colleagues as well. As if you have like 500 stock in the stock market, having an ETF to invest for you may not be that important because you can easily buy your 500 stocks, everything in the stock market yourself easily already. But if you look at like a bigger market, say the US, you have 10,000 stocks, say, in the market, and an S&P 500 invests into only 500 stocks, and that ETF helps you to get that particular exposure. And that index is something that you are looking for. That ETF will be a good vehicle for you to get that market exposure. So I think there's a sort of like a growth sort of vicious cycle. As the market develops, there's more need for an ETF. When there's an ETF that helps market flows, and that goes on and on and on. So and I think ETF, after all, is a good tool for you to provide you with the return of the market index, and and market index is usually the ones that that is more familiar by the local investors, and so ETF is one way for people to access that particular market. So I would look forward to more growth into from the Thailand market, and then subsequently having the growth in the ETF market too. So hopefully that covers the concern. Right. So The third part of my presentation today is using ETF in combination with active managers. So I asked the questions about who have used ETFs. So I would like to ask another question: who have used active funds like normal mutual funds in your investment portfolio or your client's investment portfolio? More than ETFs. So that hopefully will let you know how to use ETF more going forward with your existing portfolio of mutual funds, active funds. So I'm using this picture again because it helps to understand the active and passive a little bit more. So let's talk about the investment approach first again. So active investment approach is to make specific investments with the goals of outperforming a benchmark. Generally, mutual funds are big players in this field and are trying to beat market indices and benchmarks. Well, you wouldn't like fund managers that lose money for you, right? And our passive investment approach is to invest in accordance with predetermined strategy that does not entail forecasting. So mimicking an index is one of their objective. Not over, not below, but mimic the index, where we have most of the ETFs doing this job, or index funds are doing this job as well. So these are typical passive investment products.